So hopefully everyone can see I've shared the screen. Keith, is it all working still?
All working well, yes.
Very good. So, hello everyone. Welcome to Foulger Underwood's latest accounting M&A market update. My name is Kevin Reid, and over the next 40 minutes or so, I'll be asking questions of Foulger Underwood MD, Keith Underwood. Keith, we'd like to say hello.
Hello, good afternoon. Welcome to another series of our market updates.
Let's move on to our second slide, just so we will know what we're going to be discussing here. So today's questions are going to revolve around the M&A market for the accountancy sector in the UK. Topics are now on your screen: deal activity, current deal values. Of course, everyone's interested in those. Direction of travel for pricing, market differentiation. In other words, who's doing things differently and why. And we'll also discuss some ongoing trends and some thoughts from Keith as to where he thinks things are all heading. So I'll stop sharing that screen for a moment, give you guys the rest so you can see us in all of our glory. And for those of you who don't know, Foulger Underwood is a leading advisor to professional services firms, helping them with M&A advice through to succession planning, strategy, and leadership development, among other things. You can see some of the things that we do on foulgerunderwood.com. Obviously, don't go disappearing now. We'd like you to stay with us for the next 40 minutes or so. Some very, very quick housekeeping. We will take questions, and obviously we welcome them. So feel free to use the Q&A button to send them in, and we will broach them either as they arrive, if they fit the flow of conversation, or we'll keep them to the end of the session. As I said, today's session is around 45 minutes or so. And if you have questions that you deem sensitive, or you just like to have a chat, then of course, feel free to drop Keith a line at keith@foulgerunderwood.com. And for those of you that are watching this as a recording, then please drop a comment in on YouTube, or again, drop Keith a line. I'll just go back to my share screen. Bear with me. I have lots of buttons to press here. Okay. Keith, would you like to kick off proper deal activity?
Thanks very much, Kevin. Well, welcome to everyone who's on this webinar today. Last 4 months have been extremely active. I think we'll go straight into the activity levels and some of the recent announcements. I think what we've seen is those people entering with private equity monies perhaps a year ago, having now come through a period of 6 months, made a few announcements, but been negotiating other deals. So I think in the last 4 months, it has been extremely active. And we've had situations coming through from Cooper Parry, who made a big investment into Haynes Watts, picking up something like 60, 70 million of fees with their Southeast England offices. So they've taken over those offices. Haynes Watts continues within its other offices around the country, but that was a fairly major acquisition to absorb. We've had Summer, who might be a new name to you, who have a hub and spoke model, have taken over Carpenter Box, Simmons Gainsford, and Cowgills within the last 4 months. All reasonable sized firms, which they're intending to create as hubs and add spokes to those geographic locations.
Keith, are there any differences to the deals in either kind of like the model, basically?
Well, they're all different. I mean, so we'll get into that, I think, later on, Kevin, but all these, and there's differentiation between these models of the different private equity consolidators, and we can deal with that in a little while. I think Evelyn has also made something. This is the Smith & Williamson old vehicle owned by Tilney, and they've picked up Harwood Hutton up in northwest London, M25 area, and Creases down in Tunbridge Wells. Two, again, 5 to 10 million pound firms who would have had a good growth as independents, who have now thrown their hats in for some money taken off the table. TC announced yesterday Citron Wells in London, which is yet another acquisition for them, filling out their London operation. And then you've got some regionals who are smaller roll-ups, which you may not have heard of. Sovereign being the private equity house doing a roll-up in, I suppose, you're talking about Essex and into East Anglia. So that's Sovereign with LB Group. Again, intentions, I think, about 40, 50 million roll-up. But APRI is a private equity house taking on Shaw Gibbs. And Shaw Gibbs is now most likely a year and a half through, making some acquisitions again, tend to be in the southeast. And BKL, who took some money in within the last 9 months, is now looking to make a few announcements over the coming weeks and months. So a lot of activity. And I've just given you there an example of some nationals who are doing hubs, others in southeast England looking for smaller roll-ups, but all of them actively in the market, making approaches, and that is the reason why most of you, I would have thought, have been approached by these houses to establish whether you're interested in a sale either now or in the next couple of years. I think you
more deals on the horizon then, Keith.
More deals on the horizon. I think we've most likely got to a stage, I think for the sort of recent announcements and people's determination, that a lot of firms have now received these solicitations and are either in discussion or have gone, or are indeed decided to remain independent and continue as an independent for the next few years. No one can ever say never. It looks as though this money will be around for the next few years, but do bear in mind that these private equity houses do flip every 4 or 5 years, and there are opportunities to sell out at certain times and less opportunities at others. But it'd be interesting to see when the flips come, as we'll deal with later on in this presentation.
Yeah, don't give all the good stuff away yet, Keith.
Sorry?
Don't give all the good stuff away yet. Hold on about that.
Not yet. That's down the line. I think the feedback on the pipelines and integration, and we spent quite a bit of time talking to the private equity houses as well as their management teams running the accounting consolidation. And what's coming back from the private equity is that they're reasonably happy with progress, but the pipeline is not as strong in a few cases as they thought it would be 12 months ago when they did their DD on the sector. You've got others who are saying that the integration of accounting practices is not as fast as they expected, as it may have been in other businesses they've invested in. And to be honest, none of this is really, they should have discerned this really before they started out with their investments, because notoriously difficult to consolidate and integrate private professional service firms. And I know some of these models that we've been talking about with the announcements in the last 4 months, some of them are leaving the brand and are remaining independent as acquisitions, which means there's not much rationalization, there's not much strategic benefit taken off the bottom line. That will come in the future. It's really supplying money to make further acquisitions. And then you've got examples of quite considerable integration in places like Gravitar, which is a Tenzing vehicle, which took over CLB and Jeffries Henry and ABN down in London, which are now through a really intense period of rationalization, which I think includes new offices, what I heard, and they will be out of that. But it's been a really intensive period, changing systems, changing roles over the last 6 months, but they're coming out of it now and are ready to grow. So you get different models. The rationalization varies from model to model. It's difficult to see how some of those investments into independent firms are actually going to turn out when these private equity firms want to flip down the line. But at the moment, they're not integrating. But you just have to go back to the old Baldwin's model prior to assets, when they went out into the market 6 or 7 years ago, suggesting that brands could remain the same, wouldn't be any change. And of course, then they asked them all to change the name to Baldwin's. And then after a further 3 or 4 years, they had to change their name to Assets. So this is a constantly evolving situation. Really, once you're into these consolidator units, the real driver is the private equity house seeking the EBITDA for their exit in 4 or 5 years' time. So change and rationalization to meet that objective will take place irrespective of what might be promised up front.
Keith, if I can kind of pull together your last two bullets there around the pipeline and the PE firms seeking foundation businesses, if the pipeline is not as strong as was expected, and obviously there aren't millions and millions of double-digit million-pound firms out there, does that mean that the firms that PE houses that are still seeking foundation businesses are likely to pay a little bit more or give better terms because of the fact that there aren't as many players on the market as they'd like?
Yeah, I think that's a very good point, Kevin, and I think we're seeing some indication of that. You're absolutely right. We've got people, but we've still got some foundation PE firms looking for foundation businesses of around 30 million. And of course, the number of independents around 30 million at the moment in the marketplace is very limited. And most of those who are at that level have either decided to go and enter into discussions, or have decided to remain independent. So there is a rarity value. But of course, private equity, not in the marketplace at the moment, might see it as a crowded environment if they do the right DD on the sector, and therefore move on to another sector. I mean, so they're not necessarily committed to coming into accounting professional services. A number of them have seen it as an opportunity now on which they can make a flip in a few years' time at a reasonable multiple. But it is not necessarily it's not a compelling sector that they have to be in when compared to all the other sectors that they would be considering.
Yeah.
So if they don't find the right opportunity, if they don't find the right, if you like, runway of 5 or 6 opportunities to buy within the first year, and that's what they like to see from a foundation business. They like to see a foundation business which has actually lined up some potential acquisitions in the future and have perhaps identified them, even if are not at the stage of completion. But it gives them a runway to absorb the funds they're going to allocate to that sort of roll-up.
Okay, well, we're 15 minutes in, Keith. Let's keep this rolling on because we don't want it to be just a pure consolidator discussion. There's lots of other things going on.
We get on to the ALPs in the next slide, which we'll move on to.
Shall I hit the button?
Yes, please. Yes.
There we go.
So we're talking about current deal values, and we've touched on it in the previous 5-10 minutes, but we are seeing that some of the big ones of the 30 million plus foundation businesses are certainly going for multiples, possibly as high as 9. There might be exceptions above that we don't know about. I mean, see, all this information is kept very discreet, but you can find out certain indications as to where the values lie. I think when you come down to the practices which are being used as bolt-ons to the original roll-up, and I would include there anything up to 10 million in fees, annual fees, we are seeing, we've got about 6 or 7 opportunities at the moment where we've got private equity consolidators involved, and the multiples are around 6 times. That seems to be a relatively standard level. Some are at 5.
Keith, are you referring to EBITDA, not fees?
Yeah, sorry, these are multiples to EBITDA. Thank you, Kevin. But bear in mind that is possibly with a bit of sweet capital added in, deducted from the cash consideration, which is sweet capital, which can be monetized on the flip in 4 or 5 years' time. And usually it is a share purchase where the working capital is left in the business. And then compared to the LLPs, which is also on this slide, the LLP traditional deal has always been valuation of goodwill, might come out to say 4 or 5 times historically, but then the working capital is usually paid out to the vendor. That is a distinct difference, and it certainly accounts in some of the comparisons we're doing at the moment on different offers. It certainly accounts for a multiple of 1 time. So if a consolidator is offering 6, the actual goodwill value to compare to an LLP purchase, which is offering goodwill separately, is usually multiple of 1 times difference.
So Keith, without wishing to kind of have anyone suck eggs here, you've been referring to multiples on EBITDA. In the round, people normally talk about multiples of fees, and why is that? Why are we now talking about EBITDA more generally than fees? And obviously, talking about fees is a very kind of rough estimation of doing things.
Well, fees have always been historically the measure, but the reason for it is very historic. And to be honest, the overall market in M&A has always been on EBITDA or cash flow, repayment of investment, that type of criteria, which of course multiples on fees don't actually give you a fair payback in any respect. And it tends to conform to the old idea of 33% in terms of direct costs, 33% in terms of admin costs, and 33% profit. If you work on that basis and there's a homogeneous approach to a certain size of practice, then it might actually be reasonable to go for a multiple of fees. But at the moment, it's moving towards EBITDA. Obviously, most deals are justified on an EBITDA multiple in any case, because that's closer to cash flow. But below 2 million is still, people are still throwing around multiples of fees.
Yeah. Okay. Thank you.
To the traditional method.
Thank you.
So I think what is also coming in here is the LLPs are interested. They're in the marketplace, and I talked about the traditional firms. They're picking people up at anything between 3 times, and there are still deals going through at 3.5 times EBITDA. But that's equivalent to a multiple maybe of 90p or £1 in the pound. But the LLPs are moving up. They realize that they have to compete if they're going to be effective. And we've seen some deals from LLPs at 5 times EBITDA, which would put them on a par with some of the smaller consolidators. For fees, effectively, which are like up to the 3 million a year level. Above that, it gets a little more rarefied. And there's particularly if there's significant amount of exiting partners, the consolidators have the cash to meet those requirements, and therefore they have the field to themselves to an extent. So assets, the interesting thing here is the direction of pricing, I suppose. So we've been talking about what the consolidators are offering to the accounting practices out there in the marketplace. Of course, the consolidators are now sort of 2 years in some cases. Assets sort of in their second generational situation, are into their second, almost looking at their second flip for assets, and of course the first flip for the rest of them. So they might be 18 months into this, but the flip is going to take place in year 4 or 5. So some of these consolidators who might have shorter list of opportunities, pipelines than they thought, are actually, your point, Kevin, are actually looking at increasing offers. So we are getting some offers in, which we're trying, if we're representing the vendor, to push up to 7 times, even for a £3 million firm. There is resistance because they have to conform and get approval from the private equity house to do each of these individual deals. But I think there is some flexibility to move the price upwards in a limited opportunities situation, which I think we're going to have over the next 12 months.
I mean, we're talking about deal values. We've got another slide coming up on valuations. We've had a question in from Richard asking, when considering multiples of EBITDA, what value is substituted for the partner's own time in the calculation?
I suppose generally it depends. I'm sorry, I have to caveat it by saying it depends in the location you are. So if you're in deepest West Country, outside Exeter or the main conurbations, you might be putting in a value of 80,000 as a. You're really looking for a value to employ someone to generate the fees, irrespective of whether they're a partner or not. If you're looking at a high-end tax practice, creative tax partner, creative in London, then you might be looking at inserting 200,000 a year as a notional cost, because that's what it's going to cost you to replace that individual. But generally speaking, people are coming through with between 100,000 and 140,000 as the notional charges per partner. And of course, that has an immediate implication on the EBITDA because it's taken into account in the EBITDA, and therefore every dollar you put through there, every pound you increase your remuneration by, you drop a multiple of 6. If it's a multiple of 6 on EBITDA, you lose your monetized value out of the consideration. And yes, I mean, we've got a couple of deals. I'll say we've got a number going through at the moment where we are looking very carefully at what's being put in there as consultancy costs for the retiring partners who are going to be there for 2 years. Because the more those consultancy costs go up, the lower value they get on their consideration. So yeah, I mean, it does work, but generally speaking, I would say between 100 and 140,000 are the norms.
Yeah, very good. It was a good question. Thank you. Where are we, Keith? Are we still on this slide?
I think we'll move on to the next slide.
Let's keep it moving on.
So we relate this. We've used this one before. I'm not sure in these webinars or not, but we talk about EBITDA perhaps and multiples of fees being different. But if you look at very generally, that is a straight line, assuming you're going to make 25% EBITDA on fees after partner notional costs. So a multiple of 6 is equivalent roughly to 1.5 times fees. But you have to qualify that again, I'm afraid, by taking off a point on the multiple. So really a multiple of 6, if it includes working capital, you're most likely looking really at a multiple on fees of 1.25 or 1.2 once you've adjusted for the working capital adjustment, which the consolidators expect to be thrown in. So it are not disproportionate, unless you're a foundation business, the values being offered in that range are not significantly different. There's more value, there's more money around, but are not significantly different to perhaps where they were for an exceptional practice pre-COVID. I mean, see, as certainly, I think they'd agree that. I don't think there's anyone with us today from assets, but Baldwin's used to go around very strongly on a multiple of 1.2 times fees and picked up a lot of their underlying smaller practices on that sort of basis, which effectively they were looking for a 4 to 5 times multiple of EBITDA. So they do relate. It does relate. They're not two totally disparate measures which don't meet. So that's what I wanted to try and illustrate there. We can go on, Kevin.
Yeah.
I think I've mentioned that the LLPs are in the marketplace. They're keen to grow. A number of them strategically have got very ambitious growth targets, which includes organic growth, but also includes mergers and acquisitions. And I think the differentiation here at the moment that we're seeing is that the LLPs are positioning themselves as being able to merge. bear in mind the consolidator model is usually, well, let me say this again, it could be 100% purchase. It could be a 90% purchase with 10% left in, and in some cases it's a 75% purchase with 25% left in. But generally speaking, that is just a financial consideration, enabling the exiting partners to take a little bit of the higher consideration off the flip. When the private equity goes in 4 years' time, then that minority equity can be cashed in. But I think the LLPs have got a differentiated model here, because what they're doing for the younger partners, they are basically saying, you are merging with us. You're going to get a profit share. You're not going to get the 100 or 150,000, 140,000, which you're going to be paid by the consolidators. You're actually going to be able to grow your portfolio, and with us as an LLP, generate profit shares of possibly 300,000, 400,000, 500,000. And we've got some clients out there at the moment who are doing very nicely on 500,000. Yes, they tend to be in the southeast, but the younger partners want to maintain that profit share, because obviously they've got 10, 20 years ahead of them, and a multiple of 6 doesn't really compensate for the loss of profit shares over an extended period.
Keith, is there still a fundamental issue, though, that obviously in the model that you're describing, the argument of staying out of the consolidators is actually, if you take equity, you could actually bring home a lot of money in comparison. But isn't there still the issue of, which always kind of puts mockers on this, is the goodwill being paid out to exiting partners? How is that tension must still be there with that model?
Well, the tension's there, but it depends on the model you've adopted. There are a number of models. There are still custodian models out there, which basically distribute full profit shares to everybody, which means they have to be good profitable firms to make it work. And the younger partners are seeing a stream of profits over 15 years, rather than selling out now, taking a capital sum and trying to invest that to replace the profit shares that they're selling.
So is that older partners dwindling down their equity?
Not necessarily. I think general move on the consultancy side is that the big disparities between equity partners and fixed share partners are gradually being eroded. But I see that as a sort of 5 to 10 year cycle. It's not happening as a sudden change. But yes, I mean, to share of profitability is important to keep the second tier salaried partners on board, to make sure succession is intact and doesn't drift off elsewhere. So I think the positioning of the LLPs is quite strong. I mean, to say the consolidators are certainly looking, it's the third point there, at retiring partners, where of course they have the money to pay out the retiring partners. And if you have perhaps a practice with 6 retiring partners and 4 ongoing, the 4 ongoing are unlikely to be able to pay or compete to keep it independent, or even to raise funds to keep it independent, which we're increasingly seeing. And therefore the consolidators are very, very well placed to take over that practice. And
Keith, when you say ongoing in that model, that can mean a lot of things. There will be some that they want to actually stay on for the cycle, and there will be some that they just want to manage a handover for a year, 18 months, I guess.
Yes, I mean, if it's a year or 18 months, they're really exiting on the deal. I mean, so that's a handover period. We're really talking about people going through the first cycle, and are willing to leave some equity in there, perhaps with the consolidators, to pick up a premium sum in year 4 or 5. So yes, I mean, to say that's a possibility. There are models out there which will then take a further part of that equity and roll it on for the years 5 to 10. But of course, you don't know who the private equity new private equity parties are. You don't know how they're going to change the business model, because they will want to increase the EBITDA in years 5 to 10. and that is a further level of disruption, which we can have a look at that in a minute.
So Keith, but we're running at we're over half hour in, so we're ticking along nicely. We've had a couple of questions in. They're kind of quite technical, and I kind of feel if we can kind of try and broach them quickly now, if you're feeling right.
Fine. Yeah.
So the first one from Steve asking about, would you mind clarifying the clawback situations on a limited company share sale based on EBITDA multiples? So that's quite a complex one there.
Again, I'm afraid it's not a simple answer, but very briefly, if there is no integration and the business is being kept separate, which is a sort of ETL model, if you're aware of that, it can continue on EBITDA. If there's going to be integration, it usually reverts back on deal day to a multiple of fees. So it's translated back to a multiple of fees. Both parties can rationalize, consolidate, and integrate over the coming years, and the clawback is then driven by achieving a certain level of fees in years 1 and 2 and possibly 3.
Okay, very good. Thank you very much, Keith. And one more question from Tony, who kind of says that many offers received often include a portion of the offer to be held as preferential shares, etc., pending an exit, and thereby increasing the value of that portion. Is that kind of likely? And then second point on that is many indicate the exit will happen at the same time. So will you kind of get a glut of exits and create a buyer market?
Yeah, well, I've got a comment on that in the next 10 minutes. I think just to briefly answer that, yes, the sweet equity, as I call it, in the holding company obviously is relatively small. So it's usually 5–10% of your initial consideration and is deducted for that consideration, and is meant to tie you in. I mean, say while you retain equity, which is why I mentioned people having equity which might roll on to years 5 to 10, you have got some very stringent restrictions on going outside the business and setting up separately. The good and bad leaver clauses need to be looked at very carefully. These private equity people have been through it before, and they've got the best legal minds, making sure the clauses are very tight in terms of people going off and then taking fees with them while they have been involved in the equity. But yes,
and on the second point, we'll answer later. We have more questions coming in, Keith, so you're obviously hitting the right notes. I would say, bearing in mind we're at 35 minutes of our 45 minutes, let's just now keep wiggling through. And for everyone that has still answered questions, I can see questions from Colin and Peter. Just bear with us and we will get to those.
Okay, I think we've finished this market differentiation, which was mainly between the LLPs.
So this is an interesting slide.
Yes, all I wanted to keep on this one, all I wanted to show on this one is it's all right if you're an exiting partner and you take your cash off the table. It doesn't matter whether it's an LLP or not, but this model is really showing the consolidator life cycle. These are fairly strictly 4 to 5 years life cycles when the PE house will want to monetize the uplift. So they're buying your business at, let's say, 6 times EBITDA. They are looking to sell at somewhere north of 12 times EBITDA to another PE house. So this slide is really trying to say on day 1, year 1, the blue line, there's big change, big transition, big integration, EBITDA not so important. As you go over the years, there'll obviously be a little more transition and change brought in as they grow and bring in new systems and invest in new systems. But the EBITDA push is in year 3 because they have to prepare for their IM, for their information memorandum to go out to the marketplace in year 4 and 5 to attract another PE house. So they are really pushing for that EBITDA in year 3 and 4. And that normally includes rationalizing offices, possibly increasing fees above market rate. with the intention of getting rid of low margin business. We've seen that with a couple of people who've rationalized. So the EBITDA push, which most likely brings with it transition and change, is in those years 3 and 4. And then in year 5, you have the flip, and you have a new PE house in, which might have a totally different model. And realize in that year 5, that PE house has paid between 12 and 15 times EBITDA, and they themselves will want to see a turn on that cost when they sell in a further 4 years. Now, the only things they can do there, particularly in a professional service firms, which is not significantly scalable, elements of scalability, but 15% of cost, they can reduce cost. They can invest in more acquisitions at 6 times multiple and add it in, accumulate it, which they will do, or they will go through a major cost reduction program. And we have seen in our Asian offices, a couple of people who went at 17 on the flip, who have now turned back to the management team and said, okay, we need X million out of cost within the next 2 years so that we are well prepared for our sale and flip in 3-4 years' time.
Keith, with my journalist hat on, my blunt question would be, how feasible is it to kind of keep flipping these through?
Very good point. I have to be careful what I say here.
Or do we just save that for another day?
I mean, see, PE houses have a lot of money. They have a favorable tax situation as well at the moment, which could change. Money could become more expensive. All these will sort of influence their interest in making investments and giving a return to their investors. But that's what they're there for. They need the EBITDA up so they can make a turn, sell it on, and make a bigger return to their investors.
And I appreciate I've kind of jumped ahead a little bit there anyway.
You have a little, yes. Thanks,
Speaking of which, we're running at nearly 40 minutes, Keith. We've got questions,
okay.
So let's keep this moving on.
One other point here is in this cycle, going back to the cycle, Kevin. In that cycle, of course, people are going to join in year 3, but realize they're going to have to go through the transition and change and EBITDA improvement because this 5-year cycle is fixed. So they will only have 2 years actually to contribute to that profile the PE house wants to take to the market. So it's not necessarily 5 years for the accounting practice. Depending upon when you join the journey, you will have what remains of the 5 years. And I would say I'm using 5 years. It might be 3, it might be 4, it might be 6 or 7, but there is a fairly fixed timescale with most of these PE houses for their investments.
Yeah.
Okay.
Wonderful. So I'd just like to say we've obviously got lots of people watching. We may run over a little bit, and I hope that is that you're getting good value and that you don't have too many other things in your diary to follow on. But we may run over a few minutes.
I think the only thing looking forward on this is we're obviously looking at a major change in accounting models. The idea of having significant change in your practice, if you remain independent, you wouldn't go through some of the changes that are being exercised or adopted by some of the private equity houses. And that is good or bad. I mean, say private equity is there. It is a new model. It's meant to bring change. It's meant to raise the returns for its investors. But equally, it's taking away the responsibility and ownership from the traditional model, LLP model. Could be good, could be bad. But I'm just looking down the line here for a few years, maybe 3 years, to see what effects this might have. So at the moment, we're seeing some element, and there's always stories, and everyone will have heard these stories of clients moving away from consolidators because possibly the change has upset them, the price increases have upset them. And that's, might not be bad for the consolidator. They might be actually building a model which is part of their change new business model. and therefore they're quite happy to see these clients go. So there are opportunities for the independent to pick up clients. I think we're also seeing some CVs, and this is the thing which I find quite difficult to project. I do see that the younger partners who've been bought out, who might have been in their early years of partnership and equity holding, are disenfranchised by moving with a private equity firm. If you have a senior partner who's earning 300, 400,000, you've joined at the bottom end of the ladder as a partner, aspiring to take that profit share in the future, that has now been sold on. So the profit share, you have a ceiling to your remuneration to an extent. And that profit share, which was previously there, has been sold on to the PE house, who will take that revenue, and it won't fall to increase your own profit share in the future. You will have effectively sold out of your own equity as well. So you'll have a small amount of capital to invest and compensate. But I think that's a problem. And therefore, I do see this third point. People will join as directors on fixed profit share, will join these new consolidator models over the coming years. And I think you can see the risk takers and the aspirational high earners who want to stay in independent practices will seek out careers with those practices. It's no different to when we were working with Tenon back in the fallout from Tenon back in the year 2003. I mean, see, we did have some people come to us who wanted to get out of Tenon. They'd been reasonably senior directors. They'd served their covenants, taken a bit of money off the table, and then wanted to move back into a profit share environment with an NLP structure.
It could be argued, Keith, there are few of those people around. There's been a lot of bemoaning, hasn't there, over in recent years about younger people, next generation, not wanting to step up and take equity.
Yes, if we had another half an hour, we could cover that, Kevin. I think it is certainly a factor, the appetite of the younger partners, to take on risk. But there are still people out there who do want to take on risk, and they are quite a strong voice in those LLPs that are seeking to remain independent.
Okay, we're at our 45 minutes, Keith. Let's try and get this all wrapped up and our other questions over the next 5 minutes, if everyone's happy to stay with us.
Yeah, fine. Hopefully they are. So really, that's one of the things. So looking forward, we've also seen some senior partners who've exited from a consolidation or left earlier than the consolidation, setting up boutiques for high-end client servicing. I could most likely see a bit more of this coming around. I use the word boutique very loosely, but if you're looking at servicing high-end, high-demand clients, they are not the natural client for a consolidator long-term. And then you come back to this question of, will the director servicing that client within the consolidator model have the ambition and the interest, and if you like, that element of ownership, which is going to bring that service to a level which exceeds what the consolidators are offering. So if, in other words, what we're saying is, if you've still got significant equity in the pot, and you're building your own and you're following your own strategy within an independent firm, is your servicing level going to be the same as a fixed salary director within a consolidator? Is it 3-4 years down the line, or will it attract a different type of person who will go off in these two separate career routes, one with LLPs, risk-taking, but well remunerated, and the others who are reasonably well remunerated, but perhaps without the risk? So I think that'll be very interesting, seeing how things will develop. I think
so the output, Keith, from the flips.
Yeah, I mean, see, this is where it will come in when people flip, and we're most likely only 3 years away from it, maybe 2.5 years. because a couple of the private equities have also said they would like to be first movers, which means there are I think there are 16, 17 on our list at the moment of consolidators with different private equity behind them. The idea of them all going out the door and flipping at the same time is going to ruin their marketplace. So first movers, that expression has been used for us, with us. Not that we will be involved, but the first movers to sell on to another consolidator, onto another PE house. Certainly it answers one of the questions you just voiced, Kevin. That will certainly take place, and we might see some movement, first movers going to the marketplace, possibly within 2 years. Obviously, bear in mind, I don't think there's going to be any appetite for an IPO. I think that's out the window. I think the brokers and the market still remember Tenon and Vantis and Numerica back in the year 2000, all of which failed. And I'm not sure there's a real consensus that accounting firms are good in the general marketplace, for a quote. So I don't think that's there. So the only route these PE houses have got are to go back to other PE houses who've got money to invest, and make their turn.
Okay, let's keep this moving on. Thank you very much, Keith. I'm going to end the share screen, and I'm going to go through our questions that we have. So we really appreciate the questions we've received today. It's always good. I like to keep Keith on his toes. So Colin has sent us a question in asking, is there an appetite for a merger with continued organic growth as an offer for the target company or for the larger company? We hear of mainly retiring partners. You know,
well, you're going back to the. I mean, let's just cover that. The LLP model. I'm not sure whether you're referring to an LLP model. Is traditionally exactly that. Buy out the exiting partners. The retiring partners. The younger partners move across in a merger, and that's one of the differentiators at the moment, because they retain their profit shares and grow with the enlarged business. I think you might be referring to maybe on the consolidator side, the ETL model, where you can actually have, get some money in the door, a 51% sale. The ongoing partners retain their equity and their profit shares, and the exiting partner disappears. The only problem is there are limitations on the integration. There's limitations the investor brings to that deal other than money. So they don't have a pool of individuals to replace the exiting partners. They usually don't change the brand name, so there's no real synergy in becoming or being seen as a larger brand.
So you're doing work as you were, but without as much equity to kind of benefit from.
That's true. Yes, that's most likely summation. That's a good summation.
Who are always blunt with me, Keith, as you well know. Peter asked a question around for an MBO, what are the multiples in comparison to a sale to a third party?
I've got a valuation on my desk where they're asking for what is the MBO discount by selling internally. Struggle. We can't actually. I mean, see, this is very much. You can do a valuation of a business for a total sale. When it comes down to selling, 10% or splitting 40% between 6 partners, and the value that should prevail, there are too many subjective issues to have a really firm line. I mean, to say, we'd usually say anything up to 30% discount, but it has to have good reason for it. Otherwise, the senior partner who's exiting, who's selling off, will be, if you like, disadvantaging himself in terms of this takeout consideration.
I mean, can you have that set out in your articles, or is that by definition just going to be out of date as soon as it's kind of?
No, the shareholder agreement or the members agreement or the partnership agreement, depending on the entity, can, and we like to see it, spell out exactly what the formula is should an event take place and the senior partner exit. And that's always good. But unfortunately, I would say it only occurs in about 10% of practices or LLPs. The rest of them leave it open.
Very good. Okay, let's keep this moving on. Thank you for the question, Peter. And we've got one more from Richard, who asked, this is very much about large purchases by PE consolidators. Are individuals still buying into partnerships or acquiring small fee blocks? And I think the answer to that is yes.
Yes, we haven't really covered that today, but yes, the market, both buying and selling below the radar of actually the LLPs as well, because the bigger LLPs aren't really interested in anything below sort of 1.5 million. Exceptionally, they might be, but certainly the consolidators aren't. So the smaller firm market is still there. Yes, I'm sorry, I haven't really mentioned that, and that's still going at the sort of anywhere between, we would quote 90p and 1.2 times fees. And there is a ready market. People seem to have money to invest. Individuals coming along and buying in, I don't think we've seen many of those in the last few years.
I think is the argument though, Keith, that we're not talking in great depth about that because actually that's kind of quite solid and isn't kind of really fluctuating wildly.
Well, it's not being buffeted, if you like, or benefited from the change which has taken place, which we've been discussing today over the last 4 months, by the additional money in the marketplace. The additional money in the marketplace has affected it, yes. Most certainly moved up a little in terms of values, but you can still sell smaller practices, smaller portfolios. I think we've got a couple within the organization at the moment going at sort of 750,000 of fees, 500,000 of fees. We've got a couple of those, and we will certainly find a home for them.
Right, we're nearly running at 10 minutes overdue. So thank you for everyone for sticking with us. And I hope you've stuck with us because it's all been very valuable stuff. As you can see on the screen, Keith's details are there. So feel free to get in touch with him if you'd like to talk about your firm and its direction of travel. Otherwise, follow us on YouTube for more videos. Visit foulgerunderwood.com to find out more about us. We're also, I nearly said Twitter there. We're also on X, which is at Foulger UK. And of course, we're on LinkedIn. And we produce plenty of other videos. Please check those out. Keith, do you want to just say thank you and goodbye?
Yeah, thank you very much. We run these, I think, 3 a year, so should have another one around May time. So look forward to welcoming you to that. Thanks for attending.
Brilliant. Thank you very much, everyone. And obviously, a recording of this will be made available to you over the next few days or so. Thanks a lot. Bye.
Bye.